We are ready to finish our discussion of taxes with some odds and ends, some tax resources, audits, and then some strategies. Have you recovered from the 1040 form? Yes, I know. It was an ordeal, and you need to go over it 2, 3, maybe 4 times to really get a full appreciation for everything you did. But was it really that difficult? I think once people really sit down and study it and work through it, turns out it's really not that hard. Until you then have to learn another form. And then again, then some of the forms are much easier than others, and some of them are much harder than others. So if you are so inclined, dear students, think about it. As I said, we have an awesome class that teaches people how to do taxes at Southwestern Community College, Accounting 109. And there are opportunities in the volunteer world for you to learn and get certified. So there's possibly a side business or a business for you. Let's get started on slide 31 with tax information sources. The IRS has several methods of assistance. They used to be very inefficient and very inaccurate. Many years ago, would call 3 or 4 times. And if I got the same answer 3 out of the 4 times, I figured, okay, that must be the right answer. But now it's not as bad as it was. They have really tightened up their act in many ways. And if you call that 800 number, there is this one, I don't know how she does it. She seems to answer the phone all the time, and she is spot on. She gives you to the right person each time. No, I'm teasing. But yes, it has worked. One time, I had a real poser. I wasn't the only one. This was about 12 years ago or more. And there were plenty of people asking after the 2001 Tax Reform Act about this one aspect that seemed to be too good to be true. And it turned out it was true. They had done it. Well, it took them a while to answer it. Not only them, but lots of other people. The IRS office downtown has walk-in service. The email service has been very effective for me. There are dozens and dozens of publications and books, and one of the best is J.K. Lasser's Your Income Tax. Don't own any shares in the company. And then, of course, the IRS.gov website, which is an awesome website, folks. It really is a very good website. They have problems too, the IRS. I know somebody, or I did know her, she passed away, on a very intimate basis, who worked there for decades. My mother. And she would complain that nobody knew what was going on. So they have tightened up their act. But be careful, right? There are literally thousands of tax-related websites, and some of them are going to try to tell you things that just ain't necessarily so. Slide 32. What about software packages? Well, the by far the largest one is TurboTax, which is owned by a company called Intuit. They make Quicken and QuickBooks. But they also own TurboTax, and that's actually based here in San Diego. But they're not the only ones. Tax Act, H&R Block at Home, Tax Slayer. Yes, they're all competing out in the marketplace, and they'll let you use your browser on your cell phone or your computer to file your taxes. Some of them will say, it's free, it's free, it's free, until you actually go to file, and then they want you to pay $20 to e-file it, otherwise you have to print it and send it in. So they try to upsell you, it's called. But still, you can do it, especially now that you have a much better understanding of how the tax code works for the typical homeowner or for somebody who is an EZ filer. I use spreadsheets, and then I keep I keep track of all my data throughout the year on spreadsheets, and then I throw it into TurboTax. And I didn't used to use TurboTax. It was several years before I tried it. I actually tried it just to make sure I was doing it right, and it turned out I was. And since then, it really does make life a whole lot easier, folks. So check out the program of your choice online or download it onto your laptop computer. Slide 33. Now, how about tax preparation services? Well, here I'm going to say something a little nasty to tax preparers, and some of them are going to be angry. But be very, very careful, folks, because a lot of tax preparers really don't know what they're doing, or they think they know what they're doing. I'm not trying to say that they're trying to scam you. There are some who will, but they have got, in some cases, about as much training as you have received in this course, which is to say not a whole lot. If you really need help, folks, and they charge a lot of money. I am so amazed at how much these tax preparation services charge. And these people are, just people off the street who've learned how to do a Schedule A and the Schedule 1040 Easy. So I think you'll do better doing it yourself. Unless, here's the unless, you need a big gun. And here are the big guns, folks. Enrolled agents, by far, are the biggest guns, in my humble opinion. Because these are people who have been approved by the IRS. Often they are ex-IRS workers, and they go through thorough training, and they are thoroughly tested to make sure they understand the tax code. Accountants and CPAs are hit and miss. Some are excellent, some are worth every dime you pay, and others, they often have somebody in the back room doing the taxes for them, and they just sort of they take a look at it and they sign it off. So again, you got to be careful. Find somebody you trust. And then tax attorneys are when you're up against it, when you're actually doing battle with the IRS, you need a tax attorney. These people are not cheap, folks. You're going to spend a ton of money if you need their help. So do the best you can first, and then when you say, okay, I need a professional, all right. But even if a professional tax preparer or an enrolled agent or a CPA or a tax attorney makes a mistake, who is responsible? Right, you are. You're the one who signs the return. You're the one who's ultimately responsible. Now, some of them will say, okay, we goofed, we're sorry, we'll make you whole, but still, you're the buck. The buck stops with you. So for this reason, it is important to at least understand the forms you are signing and check that the numbers are reasonable. Not so much anymore. I'm sure they're still out there, but for many years there were these charlatans who would say, how would you like to pay no taxes this year? And people say, oh, sounds good to me. I paid $4,000 last year. Here, I'm going to do your return for you. And then they would do it fraudulently and say, sign it. Don't look at it, just sign it. And then, of course, they disappear and go some other town. And so, for this reason, I will repeat, it is important to at least understand the forms you are signing, check that the numbers are reasonable. The IRS has created a registration and testing process for tax preparers, and it has definitely gotten better. But still, you are ultimately responsible. Slide 34, tax audits. Look, relax, folks. Most audits, at least this is what the IRS tells us, are just for arithmetic errors. And it's about 1% of returns are audited. If you claim large or unusual deductions, you are more likely to be audited. If you have certain schedules, such as Schedule C, which is for businesses, or Schedule E for real estate, you're more likely to be audited. If you have it's interesting, if you make a lot of money, you're more likely to be audited. And if you claim the earned income credit, which means you don't make a whole lot of money, then you're likely to be audited too also. There are 3 types of audits. And my understanding is that the largest number are the correspondence audits. The IRS sends you a friendly, official-looking letter that says, you said you put down $500 for deductions for charity on your Schedule A. Please make a copy of the receipts and send them to us. Send them to us. So you send them the copy of the receipt, and they send you a letter back saying, thank you, we have resolved this issue. We received this once because somebody had made an error in a form that they had filed, and I didn't catch it. And when I saw it, he said I owed an extra $3,000. And no, I didn't. I was pretty sure of that. I do the best I can to make sure my taxes are correct. And when I saw the form, I said, uh-oh. So I sent them back a copy. I went to the people and got the right one. They had to send a copy directly to the IRS. They gave me a copy, and then they sent me a letter saying, thank you very much. This is the one you want, folks. If you're going to be audited, you want the correspondence audit. Because they send you a letter, you send them back a letter, and they send you a letter saying, thank you very much. Now, the office audit, it takes place at an IRS office. And they will ask you to bring this, that, and the other thing. And what do? You bring this, that, and the other thing. You say, good morning, thank you very much, good day, and you do what they ask you to do. By far, the most complex and the one that is indicative of what they think is fraud is field audit. These are their bloodhounds, folks. An IRS agent will come to your home, your business, or your accountant's office, and you want to avoid this one like the plague. And this is where you need the enrolled agent. This is where you need the CPA or the tax attorney, because they smell smoke. They think you've been doing something untoward. And the biggest things that people do are hide income or falsify expenses. But there are other games that people play. So if you are the subject of a field audit, then you do need professional help. And they can't just call you and say, we're coming tomorrow. You have rights, including the time to prepare for the audit. And when you go to the field audit, you don't actually go. You're not even going to be there. The enrolled agent, the CPA, will do it for you. Unless you really feel completely at ease with what you've done and are not, trying to hide something and are not, worried about the interpretation of how you did things, then go ahead, try to do it yourself. But I don't recommend it. I haven't ever gone through one, so I can't give you any personal experience. But I can tell you of someone I know who was at an IRS office for some other reason, and he saw a gentleman in a 3-piece silk suit, completely decked out, sobbing hysterically. Obviously, they must have caught him red-handed, and he knew he was going to be paying the consequences. So don't goof with the IRS, folks. Slide 35, tax planning strategies. So now we're going to spend a little bit of time, on some tax planning strategies. There are 2 time-honored strategies for paying fewer dollars of taxes. One of them is tax evasion, and the other one is tax avoidance. Folks, tax avoidance is perfectly legal. I had one friend who'd said, well, I don't know if I should take this expense. I said, that is perfectly legal. You go right ahead and take it. And she said, oh, all right. I'm not a professional, and I knew that was perfectly legal. And she did, and she never was audited. She was worried, but it turned out that her worries were unfounded. Tax evasion, dear students, yeah, don't do it. Don't try. Even though I told you about the 8 million children who disappeared. People do it. In some countries, it's considered a sport, right? And people brag about it, but don't. And there's something from USA Today. Americans avoid about $50 billion, and I've heard numbers that are actually higher, annually by hiding money in offshore accounts. As much as $1.6 trillion of North American wealth is held offshore. Now, the IRS has petitioned the Congress to deal with this issue, and they have created an act. I can't remember a law. I can't remember the name of it, but it seems to have gone overboard. It seems to have blown up in their faces, because now there are people who are expats, Americans living abroad, who are literally having to give up their citizenship because it is so difficult to follow these laws. Yeah, and it's an issue, isn't it? You know, the law of unintended consequences. They're trying to deal with the issue of offshore wealth held abroad to evade taxes, and they create a whole other problem of people just not even being able to live, not even be able to do with their financial day-to-day transactions because they can't abide by the rules. So nothing's perfect. Talk to your elected representative in Washington. Slide 36. So let's take a look at some strategies. Tax-deferred investments. Now, we're going to discuss these in detail when we get to 401ks, 403bs, traditional Roth IRAs, simple plans, SEP plans. And they are, on balance, pretty darn good deals that most all of us working grunts will take advantage. Tax-deferred annuities, we'll discuss annuities in detail in Chapter 11. My humble opinion, folks, and I'm a life insurance agent, is that these things are pretty much bad news. Now, if you have more money than you know what to do with, fine, go out and buy an annuity, but I'm not a big fan of these. Series EE Treasury bonds, yawn. These are great for newborns, for your niece or nephew or grandchildren to give them, and then when they go to college, they can cash it in and buy half of a textbook. And then long-term capital gains, we'll discuss that when we get to stocks and other investments. You do pay lower rates than if you had earned the income. But on slide 37, we find that one of the best tax shelters is owning a home. That is because you can deduct the mortgage loan interest and the property taxes along with the other items that we saw in Schedule A. And this reduces your taxable income. This is a paid advertisement from your friendly local real estate agent. Because what we're going to find is it's really not as great a tax shelter as the real estate agents make them out to be. Patience. We're going to discuss this in detail in just a few moments. In Chapter 5, we're going to talk about the home equity line of credit. Oh boy, sure. It might reduce your taxes a little bit, but it's a dangerous thing in the hands of somebody who does not have self-control with their credit cards. So we'll discuss this when we get to Chapter 5. Now, muni bonds, tax-exempt investments, are actually pretty good deals for the very wealthy. But for the vast majority of us working grunts, they turn out to be not the best deal. We'll discuss this when we get to Chapter 11, when we start investing. Now, one of the best investments you can ever make, it's also one of the risky investments you can ever make, is to start a business. And I wish you the best of success. And it's also a good way to reduce taxes. It's a good tax planning strategy. But the IRS says it has to be a business, which means it has to eventually start making money. It has to start making money. You can't simply have a hobby where you are losing money every year because you're buying all these expenses, but you're maybe selling one product or whatever. So we'll discuss that in a bit. But first, slide 38, let's take a look at home ownership. Because, as we'll discuss in Chapter 7, it's the American dream to have the home in the suburbs with the white picket fence and the 2.3 children in the yard. Anyway, let's take a look at a single person and a married couple, and each has an adjusted gross income, remember, bottom of page 1, top of page 2, of $50,000. Now, we worked with A King, and he was a head of household, so the deduction's a little different, the standard deduction. But for the single individual, $6,300 in 2015, doing your 2015 taxes, and the married couple, $12,600. So that subtotal is $43,700 for the single, $37,400 for the married. The single person gets one personal exemption. The married couple gets two. So the taxable income for the single person is $39,700, and the married couple $29,400. The single person is paying in 2015 $5,725 in taxes, and the married couple is paying $3,491 in taxes. And so they've been saving up for a down payment, and they're ready to go out and buy a condo at the lower end, or maybe a house if they can find one, and at the lower end of the real estate market here in San Diego. And the real estate agents jump up and down and say, oh, you have to buy. You think of all the taxes you will save. Hang on a minute. Slide 39 should look very familiar. This is the Schedule A for A King Back. And this is a typical Schedule A for somebody who owns a house, a home at the lower end of San Diego prices. $1,000 of income tax. There's the property tax that we saw, $2,900. The DMV property tax, the vehicle license fee for a newer car, and then there it is, folks. The mortgage interest that this single person or this married couple, or in our case when we did the 1040 A Kings, the head of households, $14,400. And it sounded like a lot of money, didn't it? But that's what is typical, folks. If you have a mortgage of $360,000 and you're lucky enough to get 4%, that's $14,400 a year. Gifts to charity, $500. So there's the $19,000 that we saw in the previous presentation. Looking familiar? Yeah, it should. It should. Go back and do that previous presentation again to make sure it looks familiar. So now we redo their taxes with the itemized deductions instead of the standard deduction, because you get to take the standard deduction or the itemized deduction, but you can't take both. Do I sound like a broken record? All right, so the subtotal here is $31,000. And then, again, the personal exemptions don't change. $4,000 for the single person, $8,000 for the married couple. Their taxable incomes now are $27,000 for the single person, $23,000 for the married couple, and their taxes are now reduced somewhat, $3,593, or about $300 a month for the single person, and $2,531, or a little over $200 a month. So how much are they saving? Well, it turns out that they're really not saving a whole lot of money. The single person went from $5,725 down to $3,693 for about $2,000, a little over $2,000 worth of savings, about $180, $190 a month, which is nothing to sneeze at, but that's your condo fee, maybe, right? It's paying for your condo fee, your homeowners association fee. The married couple went from $3,491 down to $2,391, $960, about $80 a month. Yeah, that pays for the utilities, maybe. For married couples buying at the lower end of the housing market, the tax savings are not as large as the real estate agents make them out to be. Now, don't get me wrong, I'm not trying to dissuade you from going out there and buying a home. I'll never forget, I had a real estate agent in my class who was jumping up and down, screaming, "You trying to convince them not to buy?" No, it's not what I'm trying to do, but I want you to have your eyes wide open. And remember that the real estate agents are going to really play up this tax saving without going through the numbers for you. And you're going to be a little piqued maybe a little bit more than piqued and maybe a lot angry when you realize that you're really not saving that much in taxes. A house is a home first, an investment and a tax shelter second, in my humble opinion, and more about this when we get to housing in Chapter 7. Now, what happens once your income starts to rise? Once you start to enter the upper middle class? Then things get a lot better for the tax shelter qualities of your home. So let's say you're a single person with an $80,000 adjusted gross income, or a married couple with an $80,000 adjusted gross income. Well, if you don't own the home, it's not likely that you're going to go over the standard deduction. Maybe you will if you're heavily donating to a charity, or maybe you have health problems. Oh boy, we don't want those to happen. But the standard deduction for the single person is $6,300. For the married couple, $12,600. There's the subtotals, and then we get to reduce that subtotal by the personal exemptions of $4,000 for the single person, $8,000 for the married couple. So now their taxable income, $69,700 for the single person, $59,400 for the married couple. The tax on the single person is $13,225. And the married couple, it's $7,991. Wouldn't we like to reduce those taxes, especially for the single person? Indeed, right, yes. As we said, married couples, they actually get a break, right, normally. So let's go out and buy a really nice house up on the hill where they do the boogie. We got a big down payment, and our state, so now our Schedule A changes dramatically. The state income tax is $2,000 or maybe a little bit more. The property taxes are $5,000 or maybe a little lot more. The DMV vehicle license fee, maybe we have 2 vehicles, $400. And look at what happens when we have a big old mortgage. Almost $30,000 in mortgage interest. And does the IRS blink or raise a suspicious eye when they see huge mortgage interest entries for the Schedule A for people in the Southern California area? No. It's even worse in Northern California. They give more to charity because they make more. So now their total itemized deductions are $37,000, which is not atypical for homeowners here in San Diego or Los Angeles or San Francisco or New York and some of the high property areas back east. Indeed. So slide number 44. We redo the 1040 with the itemized deductions, because you get to take the standard deduction or the itemized deductions, but you can't take both. And so now their subtotal is $43,000 because the $37,000 reduces the $80,000 down to $43,000. 1 personal exemption for the single person, 2 for the married couple, and we're looking at $39,000 for the single, $35,000 of taxable income. We go into the tax tables and we see that the single person's income is now down to $5,550, married couple $4,331. So this is a nice reduction. Slide 45. The single person was paying over $13,000. Now they're paying about $5,500. So they're saving over $600 a month, which is, it's a big chunk of change. The married couple went from almost $8,000 down to a little over $4,000. So they're saving about $300 a month, which is, not as much as the single person is saving, but still pretty darn good. Once your income reaches the middle to upper middle class level, a home is normally a very good tax shelter. And now this phenomenon, this situation, has also led to some a little politicking, because there are people who are saying, look, that home ownership deduction really only benefits the very wealthy. And other people say, well, who are you talking about? The very wealthy. These are people making $80,000. Are they really that wealthy? And it gets into a little bit of politics about how you measure wealth. Some people say, hey, you're not really wealthy until you're making $250,000. And I say, well, that's great, but how many? you're not a whole lot of many people making that much money. So it gets into a little bit of mudslinging and politics, because there are some people who want to get rid of. They want to get rid of the home deduction. And the reason they want to do that is because they want to get rid of all deductions. They want to simplify the tax code immensely. And of course, as soon as we discussed, as soon as you say that, the people in the real estate and the people in the charities start jumping up and down. And so if you're going to let one, then you got to let the other, and then one let the other, and we're doomed, some people think. We'll see. So don't let the real estate agents bamboozle you into thinking you're going to save a ton of money for your taxes. Buy the home because you want a home and you want to lay down roots, and there are other advantages, as we'll discuss when we get to home ownership. Slide 46, our home business, or just business example. Do you remember that $299 stereo that cost us over $500? Well, dear students, if it is a legitimate business expense, then that same $299 stereo costs us just $319. Now, how is that? Well, you still have to pay the sales tax on the item, unless you plan to turn around and resell it, right? Unless you're buying it wholesale and then selling it retail. But if you're going to use it for your business, you got to pay the sales tax. But you get to deduct the sales tax as a business expense. We have to ask ourselves, when could a stereo be a legitimate business expense? Well, do you have a DJ business, right? Do you need stereo equipment? Or do you have a storefront or an office where you play music for your clients or your customers? Yeah. I knew a gentleman who, I haven't seen him in many years, but he lives in Chula Vista and he keeps turtles. And you say, well, how many turtles does he have? He has hundreds of them in his huge garage out back, and he has to keep them warm. And he even has a Galapagos turtle. And so he gets to deduct all that energy that he uses. Yes, and he gets to write off part of his home as a legitimate business expense. And he actually does make money. He buys and sells, breeds and sells turtles, and has done pretty well for himself. It's not his, he has a daytime job, but he actually does, it is a legitimate business. He does make money, and the IRS is not going to come down on him because he's not making any money. Because you can lose money on a business, but only for so long. Yeah, right. And I have a cute little story. How are we doing for time? Not bad. Of a partnership that I did the taxes for some time, and it was actually my niece. She and her companion in crime opened up a theater production company. And they did some plays and actually made money. They actually made some money. And so I did their taxes for them. And then they did more plays, and they started to get some critical acclaim. And then it's just expected that they're going to spend more money on their productions. They called themselves Backyard Productions. And at first they were Backyard Productions. I mean, they really were low cost. But then they started, spending. And they started losing money. And they started doing this every year. And I said, well, I don't know. I mean, you're not supposed to lose money forever. And, they asked me, what should I do? What should we do? I said, well, let me call the IRS. So it took me a while. I finally got through to the right person. And he said, well, what kind of business is it? And I said, it's a theater production company. And he roared with laughter. He laughed hard. He said, oh, don't you go right ahead and lose as much money as you want. Right, theater. In the theater world, the tickets don't come close to paying what it costs for the actual production. So there you go. If you want to lose money, open up a theater. Slide 47. Donate your car. Get a tax break. Yippee! An all too familiar spiel we hear from charities these days is that you can donate your car and get a $2,500 tax break. In the 25% tax bracket, that's worth about $625. Of course, if you actually tried to sell this car, you might only get $50 for it to come pick it up. Well, not a bad deal, huh? Not anymore. The IRS says no more of this. The charity must now sell the car immediately to the recycling yard, to an auction shop. If it's in good shape, they'll try to sell it. Normally, they just part it out. And they must tell you the actual amount that they received. You understand? So instead of $2,500 for that piece of junk, you might get a $100 deduction. And if you don't itemize deductions using Schedule A and instead you take the standard deduction, then you can't take the deduction. You don't get to take advantage of it because you're taking the standard deduction, because you get to take the standard deduction or the itemized deductions, but you know what I'm going to say, you can't take both. And many people have been burnt by this tactic. They've gone back to Father Joe's or, Wounded Warrior or KPBS or Southwestern Community College Foundation and said, you told me I was going to be able to use this as a tax deduction. And they say, well, we said you might be able to do it. You have to consult your tax professional. Yeah, I'm not trying to stop you from donating your car or clothing or whatever. I mean, go right ahead, donate to your charity, but you do it because it's good for the charity, it's good for the society, and you may or may not get a tax break. So, here we are. We're at our end of our discussion of taxes. And the bottom line is where we started. Death and taxes. Good old Ben. Pay your taxes, quit complaining, or go right ahead and complain. But instead of complaining, I like to think about the good I'm getting from my taxes when I ride along a freeway, or when I turn on the water faucet, or flush the toilet, or watch that aircraft carrier go off to sea. Ben was actually wrong. He should have said the only thing certain in life is death, taxes, and tax law changes. Because sure enough, they're going to goof with it. But if we want real reform, and I think this is absolutely possible, but don't hold your breath, as I say on the slide, all we really have to do is require the senators and representatives in Congress to do their own tax returns, because they don't. I think it's the government, GAO, Government Accounting Office, or it's either the IRS, send people up onto Capitol Hill, and they get and the senators and the representatives have their taxes done for them. Well, of course they don't care how complicated they are, right? It's being done for them. So if we made them do their own taxes and took Business 121 and Accounting 109, then things might change a whole lot faster than we ever thought they could. But don't hold your breath. Well done, students. Go back over. Make sure you understand the tax consequences of owning a home. Make sure you can do that 1040 form. And I am very proud of you